Hello, welcome to the presentation of Team 15's Managerial Economics and Business Analysis Capstone. We have selected Brunswick Corporation as the company for the Capstone study. Headquartered in Network, Illinois of the United States and listed in the New York Stock Exchange with stock code BC, the company owns numerous leading lifestyle brands and popular boating brands. This analysis focuses on the treadmill product under the Life Fitness brand. Life Fitness is the global leader of commercial fitness equipment manufacturing in terms of revenue. The treadmill is the best-selling fitness equipment category, and Life Fitness is primarily producing its treadmills exclusively in the US. We are interested in exploring the concept of moving its manufacturing offshore to expand business opportunities and increase revenue. The fitness equipment market is a monopolistic market. There are relatively large numbers of suppliers and a few large ones amongst them. Across different manufacturers, the treadmill product offer is differentiated among the features set. Each manufacturer is trying to make their unique offering to create a competitive advantage, as the technology involved in making a treadmill is not extremely advanced, and OEM factories that specialize in making treadmills do exist. Market entry and exit is relatively easy. Non-price competition is very important, or the profit margin suffers. In the industry, commercial use treadmill manufacturers are categorized into international brands and low-cost brands. International brands are defined as globally recognized fitness equipment brands. Their commercial treadmill unit selling price is $2,000 or above. The international brands are estimated to contribute to 50% of the commercial fitness equipment revenue. From industry intelligence, the top 5 brands contribute to over 80% of the international brands' revenue in the commercial equipment segment. Low-cost brands mainly come from China and Taiwan with a unit price of below $2,000 per treadmill. The distinct leading brands in this lower segment is less obvious. The short-term and long-term pricing and profitability for monopolistic competition are shown on the following models. The graph on the left shows the short-run condition of the market. The dark red line shows the average revenue, AR, or demand curve. The pink line shows the marginal revenue, MR curve. The blue line shows the marginal cost curve, MC, and the green line shows the average total cost, ATC curve. Profit maximization is where the marginal cost is equal to the marginal revenue. The quantity is Q and price is P. The graph on the left shows the short-run condition. The demand is located above the point where the ATC intersects with Q. This condition allows economic profit to be greater than 0, which is shown in the area of PCBA. This economic profit will attract new entrants. Due to low barrier of entry and exit, the demand curve will shift to the left and erode the economic profit as shown. The right graph shows that in the long run, the economic profit will be 0. Since most economic profit is made during the short-run condition, firms tend to try to maintain the short-run condition by creating differentiation through continuous innovation and marketing campaigns. Price discrimination in monopolistic competition is shown on the right graph. The economic profit in the price discriminating monopolist is bigger than the single price monopolist, as the firm is able to charge different prices to different customers. This condition is mainly driven by market segmentation based on elasticity of demand. For example, a gym or fitness club has an inelastic demand, as fitness equipment is required to run their business. Macroeconomic analysis, country ranking. The region that showed the highest and most consistent growth in sales of our product was Asia Pacific. We shortlisted and ranked 10 developing countries from this region: Bangladesh, China, India, Indonesia, Malaysia, Pakistan, Philippines, Sri Lanka, Thailand, and Vietnam. Countries were ranked in accordance to which indicated the strongest growth and revenue potential for our company's expansion, from 1 to 10, where 1 was the highest and 10 the worst, as depicted in this graph. For ease, the darker the blue, the stronger the positive affiliation. Based on our analysis and ranking, our country of choice is China. We gathered the data for analyzing the variables from a variety of sources. This heat map displays the score for each country obtained under each variable. As we have 10 countries, the scale is 1 to 10, where 10 is calculated here to have the highest and best score, whilst 1 is worst. We looked at key variables from formula and function in macroeconomics. from the equation GDP is equal to consumption plus investment plus government expenditure plus net exports, and derived our variables from there for analysis. There are many other factors also included in our comprehensive analysis, such as population, health, infrastructure, pay, and productivity when we did the country ranking. From the graph, you can see that China's annual GDP growth rate has been steadily increasing, indicating strong consumption, leading to potentially higher demand for our treadmill. The target market for treadmills is predominantly middle to upper class individuals. China has a very significant growing GDP per capita PPP, so it is necessary to analyse this variable as it gives us better understanding of the purchasing power of the population in the country. Although the end customers will be predominantly fitness centres, GDP per capita PPP gives us a better indication of the potential market size and sales of our treadmill. This graph shows us the GDP per capita PPP has more than doubled from 2008 to 2017, suggesting a significant increase in the Chinese population's purchasing power and supporting our decision to expand into China. Of significance to us is the purchasing power of China's currency in terms of real goods and services that are adjusted for the effects of inflation. China's exchange rate is partially fixed US dollar, allowing China's manufacturing industry to be very competitive, producing goods at much lower rates than many other countries. It must be noted that China's currency is currently floating. There is therefore some risk associated with this. Should the currency depreciate, it will be to our advantage, as the lower the real exchange rate of a country, the more competitive that country is in international markets. We want to produce in markets with lower real exchange rates so that we can produce goods at cheaper rates than our foreign competitors. Furthermore, consumers within the country with the lower real effective exchange rate will find purchasing foreign goods more expensive and therefore be more likely to purchase locally produced goods, such as ours. Should the currency appreciate, however, the opposite will be true. We'll be producing goods at more expensive rates than our foreign competitors, and the purchasing of foreign goods from within China will become cheaper, which is not good for us since we'll be manufacturing and selling from within China. We forecast that the government will try to keep the currency low to ensure China remains an export-oriented economy. The real exchange rate is directly connected to the amount of money held in the country and is used to determine the cost of capital, which is very relevant to us. As the country's interest rate has gone down, it is favourable to our expansion into the country. However, we would need to take note that the interest rate may go up in future, and we will need to assess how that would impact our investment. The low and stable inflation rates encourage consumption and investment in the economy, supporting our decision to expand into China. The low and stable unemployment rates suggest the country has an adequate labour force to support the production of the business and grow the economy. The country's large trade surplus suggests the economy has a comparative advantage in manufacturing goods and services due to optimal factor endowments, such as labour, land and capital. Productivity, trade policies, exchange rate, inflation and demand for its goods and services. This could be due to fiscal and monetary policies in place that encourage exports to grow the economy. All in all, it is clear the country has favourable economic factors that make its exports attractive. The country has never ceased to attract inward investment, given the whopping $844.5 billion on average in FDI from 2008 to 2016. The FDI exceeded $1 trillion in 2014 and has increased steadily since then. Similar to balance of goods and services, this is a positive indicator that shows foreign investors are attracted to the country due to favourable factors for setting up and running businesses to meet local demands or for exports. Credit rating agencies rate countries based on their risk level relating to politics and economics, specifically sovereign default risk or payment default risk for exporters. The good investment grades that the agencies have given China indicate that the country is a relatively low-risk country for investment and thus again supports our decision to expand into the country. The strong growth of consumption expenditure in the country suggests that the incomes among the population have gone up, which can also be suggested by an increase in the purchasing power explained earlier in this presentation. At household level, this indicates a change in lifestyle with increased consumption expenditure on recreational activities. Given the sizable population and increased purchasing power of the country, this strongly increases our growth and revenue opportunities for manufacturing and selling our product in China. In the past 5 years, the country has climbed up in the worldwide ranking for institutions, which includes 1. Political environment, political stability and absence of violence, terrorism, government effectiveness. 2. Regulatory environment, regulatory quality, rule of law, cost of redundancy dismissal. 3. Business environment, ease of starting a business, ease of resolving insolvency. The sharp improvement in the ranking shows the country's resolution in creating an investment-friendly environment to grow its economy. The Chinese government has put in efforts to improve its institutions to attract investment. Again, all the factors are favourable to our investment. In the previously seen charts, we have studied each variable and how they led us to the conclusion that China is the optimal choice of country to expand into. China's policies are very congenial for our company's expansion, as we will now explain. In a bid to ensure China has long-term sustainable growth, the current governmental strategy is to increase domestic consumption. Furthermore, China is currently implementing initiatives to improve the health level of their population. Our health-promoting treadmill is extremely suitable for China's current direction and policies. China is currently very protective of their local products, and there is a general drive towards purchasing locally made goods, which will work in our favour, as it is our intention to manufacture the treadmill from within China, therefore making this country an excellent choice for our company to expand into. China and the US are currently in a trade war. However, these tariffs are not considered to be so detrimental to our expansion into the country, as we will be manufacturing and selling domestically. Furthermore, it is assumed the trade war is a temporary concern. We have learned from our competitors that Chinese consumers are wanting quality manufacturing standards to the highest degree. Currently, our competitors are unable to deliver the quality demanded. The current brands in China, the Chinese market, are not top-range brands. Our brand will fill that gap and deliver the quality treadmills that the Chinese consumers are seeking. China's infrastructure is very good. Labour costs in China are currently low, although it is increasing, and it is expected to potentially have negative effects on our profit margins. China's emerging market economy currently has high growth rates and soaring urbanization rates that creates countless opportunities outside of the traditional markets like Shanghai, Beijing, and Guangzhou. There are 112 cities in China. It holds a very large population. As saturated as it may seem, with the right products, strategy, funds, and focus, there is always room to enter or grow market share in China. China is rapidly becoming one of the most attractive consumer markets on the planet for foreign brands, with the country's middle class expected to grow fourfold by 2025, according to the Oxford Economics. It is for all these reasons we feel China is the ultimate country for us to expand into. Thank you for your time. If you have any questions, please do not hesitate to ask.